Mr. AG Asian Guy here. What happened today in the precious metals market contradicts everything you've been told about how gold and silver are supposed to behave. And if you don't understand why it happened, you're going to make serious mistakes in the days ahead. Gold plunged roughly 5% to around $5,049. Earlier in the session, it was down more than 6%. Silver got absolutely hammered, down over 9% to $80.67. The intraday low was 78.06. Just yesterday, silver was trading around $97. That's its highest level since crashing from a record above 120 in late January. Now, here's what should confuse you if you've been paying attention to the traditional narrative. Iran tensions are spiking. The Strait of Hormuz is effectively halted. Geopolitical chaos is escalating across the Middle East. U.S. embassies are closing. Vessels are being attacked. According to the traditional playbook, this should send gold and silver screaming higher. Geopolitical uncertainty equals safe haven demand. Fear equals flight to precious metals. That's what you've been told. But that's not what's happening. Gold and silver are plunging. And if you understand why, you understand something critically important about how markets actually work versus how people think they work. Before we go any further, let me be absolutely clear about something that I say in every video. I don't sell courses. I don't sell signals. I don't sell memberships or mentorships or anything else. If someone out there is claiming to be Mr. AG Asian Guy and trying to sell you something, that is not me. Block them immediately. I share analysis here. I give you the raw data. I show you both sides of every situation, and then you make your own decisions. That's what this channel has always been about. I'm only on YouTube and X. Those are the only two platforms where you'll find the real Mr. AG Asian Guy. Protect yourself. Now, I want to hear from you right away. Drop a comment below and tell me where you're watching from today. Are you in North America, Europe, Asia, the Middle East? And tell me honestly, did today's price action surprise you? Did you expect gold and silver to rally on the Iran news instead of crash? I read every single comment, and your honest feedback helps me understand what the community needs. Let me explain exactly why this is happening, because the logic chain is critical. The market has shifted its focus. Rather than boosting gold's traditional safe haven appeal, the intensifying Middle East conflict is fueling concerns that higher energy prices could reignite inflation and delay monetary easing. Let me read you a direct quote from Thulan Nguyen, head of Forex and Commodity Research at Commerzbank. She told the Wall Street Journal that precious metals are losing ground because the market is, quote, placing greater weight on the inflationary risks resulting from the war in the Middle East and therefore scaling back its expectations for interest rate cuts. This is the key insight. War is being priced as inflationary, not as protective. The market isn't looking at Iran and thinking safe haven. The market is looking at Iran and thinking higher oil prices, higher inflation, higher for longer interest rates, delayed Fed cuts. And why does that matter for gold and silver? Because precious metals don't pay interest. When interest rates are high or expected to stay high, the opportunity cost of holding gold and silver increases. You could be earning yield in bonds or savings accounts. Gold just sits there. In a higher for longer environment, that relative disadvantage weighs on precious metals prices. Let me give you the numbers on how rate expectations have shifted. Markets that had fully priced in 2 quarter-point rate cuts as recently as Friday are now assigning roughly 80% odds of more than one cut. That's a significant shift in just a few days. The certainty around easing has diminished. The probability distribution has moved toward fewer cuts, later cuts, or potentially no cuts at all if inflation reaccelerates. And why would inflation reaccelerate? Because of what's happening with oil. Oil prices have surged following the outbreak of hostilities. U.S. West Texas Intermediate crude jumped 7% on Monday. Brent futures climbed as much as 8%, reaching their highest level in more than a year. The conflict has effectively halted traffic through the Strait of Hormuz. Let me emphasize how significant that is. The Strait of Hormuz is a critical choke point that handles about 15% of the world's oil supply. 15%. That's not a minor disruption. That's a major supply shock. Analysts warn that prolonged disruption could push crude above $100 per barrel. Some are suggesting even higher. And here's the mechanism that connects oil to everything else. Thierry Wisman of Macquarie Group explained it clearly. He told CNBC that, quote, war has proven to be inflationary, as it is associated with negative supply shocks. He cited higher insurance premiums and rerouted maritime shipping as drivers of rising costs. When it costs more to ship goods, when insurance premiums spike, when vessels have to take longer routes to avoid conflict zones, all of those costs get passed through to consumers. Inflation rises. Philip Lane, chief economist at the European Central Bank, told the Financial Times that higher oil prices place, quote, upward pressure on inflation, especially in the near term, with the ultimate impact depending on the breadth and duration of the conflict. So the logic chain is clear. Iran conflict leads to Strait of Hormuz disruption. Disruption leads to higher oil prices. Higher oil leads to higher inflation. Higher inflation leads to delayed Fed rate cuts. Delayed rate cuts lead to a stronger dollar and higher bond yields. Stronger dollar and higher yields create headwinds for precious metals. Gold and silver fall. This is counterintuitive but logical once you understand the mechanism. Quick pause here. Are you following Mr. AG Asian Guy on X yet? That's where I post real-time updates when market dynamics shift like this. Today's move caught a lot of people off guard. If you'd been following the analysis, you would have understood the inflation mechanism before it played out in prices. The handle is Mr. AG Asian Guy. Go follow right now. Also, we have a WhatsApp community where people discuss these developments, share their analysis, and help each other understand what's really driving markets. The link is in the description. It's free. Just a community of people who want to see past the surface level narratives. Now let me talk about the dollar because this is the other critical piece of the puzzle. Ross Norman, a respected precious metals analyst, told Reuters that, quote, the dollar is absolutely roaring away, as are U.S. treasuries, and that's providing a strong headwind to gold and particularly silver. Absolutely roaring away. That's strong language from a measured analyst. The dollar has surged to multi-week highs. And here's what's particularly important for understanding the current dynamic. Andrew Hazlitt, a foreign exchange trader at Monex, described the dollar as, quote, the ultimate safe haven amid rising oil and gas prices tied to the Iran conflict. Let that sink in. The dollar is being treated as the ultimate safe haven, not gold. The dollar. This is a crucial shift in market psychology. When geopolitical chaos erupts, there's a flight to safety. But which safe haven captures that flight matters enormously for precious metals. If the flight goes to gold, gold rallies. If the flight goes to the dollar, gold faces headwinds because gold is priced in dollars. A stronger dollar means it takes fewer dollars to buy the same amount of gold. The price in dollar terms falls. Right now, the flight is going to the dollar. The market is treating dollars as the safest asset in this environment. That's a headwind for gold and an even bigger headwind for silver. Why is silver getting hit harder? Because silver has more industrial applications than gold. Silver is used in solar panels, electronics, medical devices, and countless other applications. When the market worries about economic disruption, about recession risk, about industrial slowdown, silver gets hit from both sides. It loses the safe haven bid, and it loses the industrial demand expectation. Gold is more purely monetary. It's more purely a safe haven asset. So while gold is down 5%, silver is down over 9%. Let me address the equity sell-off because this adds another layer to the pressure on precious metals. Gold's decline was exacerbated by a deepening sell-off in equities. According to Michael Hay, commodity strategist at Societe Generale, some investors were forced to liquidate precious metals positions to meet margin calls elsewhere in their portfolios. This is a dynamic we've discussed before. In a broad risk-off environment, correlation can go to 1. Everything sells. Investors who are over-leveraged in equities need to raise cash. They sell whatever they can. Precious metals, despite being safe havens in theory, get sold along with everything else because investors need liquidity. This is the kind of forced selling that creates dislocations between fundamental value and market price. The selling isn't happening because the fundamental case for precious metals has changed. It's happening because leveraged investors need cash and they're selling everything to get it. For patient, well-capitalized investors, this creates opportunity. For over-leveraged traders, this creates destruction. Know which category you're in. Quick engagement check. How many of you got caught in today's move? Drop a comment below and be honest. Were you positioned for a rally on the Iran news? Did the plunge catch you off guard? Understanding what happened helps you avoid making the same mistake next time. And for those of you who were positioned correctly, tell me how you read the situation. What signals were you watching? Let me talk about what comes next, because despite the sharp pullback, the outlook isn't uniformly bearish. Fitch Solutions analysts have suggested gold could once again surpass $5,600 unless the conflict de-escalates. Swiss private bank Union Bancaire Privee said there is, quote, ample scope for bullion to challenge its late January record high should the war extend for several weeks. These are credible institutions making bullish projections despite today's sell-off. Why? Because the inflation mechanism works both ways over different time horizons. In the short term, inflation fears trigger rate cut recalibration and dollar strength. That's bearish for precious metals immediately. But over the medium term, if inflation actually materializes and persists, that's ultimately bullish for precious metals as hedges against currency debasement. Think about it this way. If oil stays at $100 per barrel for months, if shipping costs remain elevated, if supply chains remain disrupted, inflation won't just be a fear. It will be a reality. And when inflation is a persistent reality, not just a fear, the calculus changes. Gold becomes a necessary hedge, not an optional allocation. Rania Ghul, an analyst at XS.com, told the Wall Street Journal that gold may emerge as, quote, the clearest compass for gauging global market anxiety if U.S.-Iran tensions continue to intensify. The clearest compass for global market anxiety. That's a powerful framing. It suggests that as uncertainty persists, gold reasserts its role as the primary fear gauge. The current dollar-driven sell-off may be temporary. The underlying drivers of precious metals demand haven't disappeared. Let me also remind you of the context we've been tracking. Before this sell-off, volatility in metals had been elevated for months. Both gold and silver soared to record highs earlier this year. Gold above 5,600, silver above 120. These records were fueled by geopolitical tensions, trade concerns, and questions about Federal Reserve independence. The recent drop follows a partial recovery from a sharp late January crash. So we're not in uncharted territory. We've seen violent swings before. We've seen sell-offs that looked catastrophic at the moment resolve into buying opportunities. The question is whether this is one of those moments. Even before the latest escalation, signs of building U.S. inflation were emerging. Manufacturing input prices rose in February at the fastest pace since 2022, according to the Institute for Supply Management. J.P. Morgan CEO Jamie Dimon recently warned that inflation could become a, quote, skunk at a party for the U.S. economy. Skunk at a party. That's colorful language from one of the most powerful bankers in the world. He's warning that inflation could spoil the optimism, disrupt the recovery narrative, force painful policy responses. If he's right, precious metals ultimately benefit from that environment. Not immediately, but eventually. The question is how much pain occurs between now and eventually. Let me give you both scenarios clearly because you need to understand the range of possibilities. Bearish scenario for precious metals. The dollar continues strengthening. The market firmly prices out rate cut expectations. Bond yields rise further. The opportunity cost of holding non-yielding assets like gold and silver increases. Investors continue preferring dollar-denominated safe havens over precious metals. The equity sell-off continues, forcing more liquidation of precious metals positions to meet margin calls. Forced selling overwhelms fundamental buyers. Prices fall further. The Iran situation de-escalates faster than expected. Oil prices retreat from recent highs. Inflation fears diminish. The urgency around hedging disappears. Safe haven demand evaporates. Silver breaks below the $78 intraday low. The $70 target we've discussed previously comes into play. Things get ugly quickly as technical damage accumulates. Gold breaks below $5,000 and tests lower support levels. The record highs from earlier this year feel like a distant memory. Anyone who bought near the top is underwater with no clear path to recovery in the near term. That's the bearish scenario. Now the bullish scenario. The Iran situation persists or escalates further. The Strait of Hormuz remains disrupted for weeks, not days. Oil prices push above $100 per barrel and stay there. Inflation doesn't just threaten, it materializes in the data. Central banks are forced to acknowledge that rate cuts are off the table. But here's where it gets interesting. If inflation becomes entrenched, the Fed faces an impossible choice. Keep rates high and crush the economy, or cut rates anyway and let inflation run. Either choice has profound implications for precious metals. If the Fed maintains restrictive policy and causes a recession, the economic damage eventually forces emergency rate cuts anyway. Gold rallies on monetary easing expectations. If the Fed cuts despite inflation, that's even more bullish for gold. It signals that monetary discipline is abandoned. Currency debasement accelerates. Gold's role as an inflation hedge becomes paramount. The forced selling from margin calls creates a washout. Weak hands are eliminated. Patient accumulators buy the dip. When the selling pressure exhausts, the fundamental drivers reassert themselves. Physical demand from the East continues regardless of paper price movements. China and India continue accumulating. COMEX inventories continue depleting. The paper-physical disconnect we've been tracking eventually forces price discovery in the physical market's favor. Gold reclaims $5,600 and pushes toward new records. Silver recovers and resumes its outperformance of gold as the bull market broadens. The 9% down day is remembered as a shakeout, not a trend reversal. That's the bullish scenario. Both are possible. Neither is certain. The key is understanding the drivers and watching for confirmation of either direction. Quick pause. How are you positioned right now? Did you add on today's sell-off, or are you waiting for more clarity? Drop a comment below and let me know. I'm curious what the community is doing. Are you seeing this as opportunity or danger? Your perspective helps others think through their own approach. Let me talk about the specific levels to watch because technical analysis matters in these moments. For silver, the 78.06 intraday low is your immediate reference point. The market found buyers there today. If that level holds on a closing basis and on any retest, that's constructive. It suggests the worst of the selling is being absorbed. The $80 area is psychological support and roughly where the 50-day EMA sits. Holding above 80 keeps the structure intact. Losing 80 opens up the $70 target. Below 70, things deteriorate significantly. On the upside, the $90 area remains resistance. Getting back above 90 would signal that the sell-off was indeed a shakeout and that buyers are regaining control. For gold, the $5,000 level is critical psychological support. Losing $5,000 would be a significant psychological blow. Holding above $5,000 suggests the market is finding value here. The intraday low extended well below $5,000 early in the session before recovering. The fact that price bounced back above $5,000 is constructive, but it needs to hold. On the upside, watch the 5,200 to 5,300 range as initial resistance. Getting back above 5,600 would confirm the bull market remains intact. The analysts suggesting 5,600 is achievable are looking at that level as validation of the longer-term thesis. Let me address what you should do practically because analysis is only useful if it informs action. First, assess your position sizing. Today was a reminder that precious metals can move violently in either direction. If today's move caused you panic or forced selling, you were sized too large. In volatile environments, smaller positions allow you to survive the swings and maintain the discipline to execute your strategy. Second, understand your time frame. If you're trading short-term, today's move either stopped you out or created opportunity depending on your direction. Short-term trading requires strict risk management. If you're accumulating for the long term, today's sell-off is noise. Painful noise, but noise. The fundamental drivers haven't changed. Third, watch the drivers we discussed. Dollar direction matters. If DXY continues strengthening, precious metals face continued headwinds. If DXY reverses, that removes a major obstacle. Oil prices matter. If crude stays elevated, inflation fears persist. That's eventually bullish for precious metals, but immediately complicated due to rate expectations. Fed commentary matters. Any signals about rate cut timing, inflation concerns, or policy stance will move markets. Watch for Fed speak in the days ahead. Geopolitical developments matter most. The Iran situation is the primary variable. De-escalation removes the fear premium entirely. Escalation intensifies both the inflation trade and the safe haven dynamic. At some point, if things get bad enough, gold's safe haven appeal overwhelms the inflation rate calculation. That point apparently hasn't been reached yet. Let me be very direct about something. The market's reaction today challenges the simplistic narrative that geopolitical chaos automatically equals higher gold prices. It doesn't. Markets are complex. Multiple forces interact. The dollar, rates, inflation, and safe haven demand all matter. The net effect depends on which force dominates. Today, inflation fears and dollar strength dominated safe haven demand. That could change tomorrow. Markets are dynamic. The forces are constantly shifting. Being dogmatic about outcomes in a complex environment is a recipe for losses. Flexibility matters. Understanding multiple scenarios matters. Position sizing matters. Having cash available for opportunities matters. Being emotionally prepared for volatility matters. Let me give you 3 key takeaways before we wrap up. Number 1, the market has flipped the script on precious metals. Iran tensions are being priced as inflationary, not as safe haven triggers. Higher oil from Strait of Hormuz disruption leads to higher inflation expectations. Higher inflation leads to scaled back Fed rate cut expectations. Scaled back rate cuts support the dollar and create headwinds for non-yielding assets like gold and silver. The dollar is being treated as the ultimate safe haven, not gold. Silver is down over 9% to around $80. Gold is down roughly 5% to around $5,050. This is counterintuitive but logical once you understand the inflation mechanism. Number 2, the sell-off was exacerbated by forced liquidation as investors sold precious metals positions to meet margin calls from equity losses elsewhere. This type of selling creates dislocations between fundamental value and market price. For over-leveraged traders, it's devastating. For patient, well-capitalized investors, it creates opportunity. Know which category you're in. Position sizing matters more than ever in volatile environments. If today's move caused panic, you were sized too large. Number 3, despite the sharp pullback, the medium-term outlook isn't uniformly bearish. Fitch Solutions suggests gold could surpass $5,600 if the conflict persists. Union Bancaire Privee sees ample scope for new highs. If inflation materializes rather than just being feared, that ultimately supports precious metals as hedges. The forced selling creates washout conditions that often precede recoveries. The key levels are $78 and $80 for silver, $5,000 for gold. Watch these levels for confirmation of either continued bearishness or bottoming action. That's the picture as I see it. The market dynamics that caused today's plunge. The logic chain connecting Iran to inflation to rates to the dollar to precious metals. Both scenarios for what comes next. The specific levels to watch. If this kind of analysis helps you understand why the market did what it did today, if it helps you avoid the confusion that caught many off guard, hit subscribe. It's free. It helps the channel grow. And it helps me keep creating this content for you. Also, join our WhatsApp community. The link is in the description. It's a place where we discuss these developments in real time, share analysis, and help each other navigate volatile markets. And follow Mr. AG Asian Guy on X for real-time updates when situations are developing. Looking at the numbers, about 70% of you watching right now aren't subscribed. If today's video helped you understand something you didn't understand before, subscribe. That's how we build a community focused on actual market education rather than hype and predictions. If this isn't for you, no hard feelings. I'm here for people who want to understand how markets actually work. Stay sharp. Watch the levels. Watch the dollar. Watch the Iran developments. The market just reminded everyone that nothing moves in a straight line and that traditional narratives can fail when conditions change. Be flexible. Be prepared. Be sized appropriately. Do your own due diligence. Understand the risks. Be accountable for your own decisions. Don't follow anyone blindly, including me. Today was a reminder that markets can move violently against consensus expectations. Volatility rewards the prepared and punishes the complacent. This is Mr. AG Asian Guy. I'll see you in the next one.